The topic today is a tricky one because we have uh, a difficult topic. There are people of all kinds of skills who know a lot about stock markets, some people who don't know as much. So it's always a difficult at what level should I be talking about. But I spent in my own life lots of time learning about stock market, investment, option trading. I spent maybe tens of thousands of dollars accumulating the knowledge over the last 20, 25 years. So I really think that it'll be fun to share it with you guys. And that's my game plan today. And so the thing is, feel free to ask questions. You can put them in chat window. And if I'm not paying attention, you can unmute yourself and ask question. You can let it be interactive because there's a lot we can discuss. So I'm going to assume that most people don't know that much about stocks. And I'm going to start by some pretty basic definitions even. So don't freak out. And Ron Collette will say, is this going to be that boring and stupid? No, no, I get to cover it, called, and put some. So it will get more interesting as we go. It'll be a steep curve. Uh, so basically, these are some of the topics I was hoping to cover. That what are the stocks? How does stock market work? And even talk about option trading because I'll share with you there's some techniques which are risk-free or no additional risk can really make money if you know how to play them. We'll discuss them too. We'll talk about even how do you get started if you know nothing about it. What is the complication and how does it get started? So with that in mind, we'll dive right into it. So one of the thing is where do you invest and what are these things? What is a stock? What's a bond? How do can I invest in real estate somehow easily without having to buy a house or an apartment building? So all these things are different asset classes, and all of them have a different risk profile. But just to make sure we're on the same page, realize stock is a partial fractional ownership of a company. So when company becomes stable enough and it can get a permission from Securities and Exchange Commission to list its stock on a public market so people like you and I can buy it. It's called initial public offering when you first time you're able to do it, IPO. Then you and I, anybody can buy a share of a company and you become an owner of the company. You can even buy one share of Apple and you will be a owner of Apple, the company, the corporation, a very small one. They have a billion share outstanding, but you can do that. What's a bond? Bond is really a loan. So when a city wants to build schools, they issue bond, 10-year bond, paying let's say 5 or 6% interest rate, so they can borrow that money because city has a right to collect taxes through property tax. They can pay back over 10 years. So loan is a loan issued by a company, by a corporation, by a city, by a state, by the US government. So bonds are basically loans with some promised interest rate, and that interest rate is then given back to the, the people who supply the money. So you and I can participate in a bond if city of Palo Alto needed money to build a new school, and over 10 year, 15 year, 20 years, we'll get our money back plus some interest. Could be 3%, could be 5%, could be 7%. Similarly, real estate, you can also invest in a what's called REIT, real estate investment trust. And this is when you pool money from a whole bunch of people, you can buy buildings, commercial buildings, private buildings, and you can run them and they return the money back to the people who contributed. So these are all different asset classes. By commodities, this could be metals, gold, silver. This could be oil. This could be pork bellies. These are all commodities. And high yield savings account is another thing when you can take the money from people, invest and generate returns by giving the money. So the way stock market works is you may have seen charts like that. What do they mean? The chart like that shows over a x-axis is time. Over a period of time, the closing at the end of the day, at what price a stock closed. So this shows you history that each dot represent what was the ending price for that stock. You can see stock goes up, they come down, they go up, they come down, they go up. But in general, if you
the
keep the
value
money in the
of
stock market,
invested
historically, returns could be quite attractive. And I'll show you some numbers in a
yeah,
few minutes.
stock market
So, so
open.
again, guys, if you questions come up to mind, feel free to uh, ask. And Subhani Patan, I'll address your questions a little bit later. So if you look at the long-term history, this is 1926 till recently to 2013. That's a pretty long period of time. You notice if you have put money in the stock market with all the crash of 1929 and all the other good and bad things happen, that dollar would have turned into $4,677. So you can see that even with the inflation, you would have done over the long period of time about 10% return if you had put money in the stock market. So for a lot of you young people who don't need the money immediately in the next couple of 3 years, you're not approaching your retirement age and worried about this, you need to have a method of putting away some money in the stock market for the long term because this is the best way to protect against inflation and grow your money. So this is the big picture. All the pluses and minuses have been factored in. The crash of 2000 is right here. This looks like a little blip now. So now the question is, where do you invest? So obviously you can buy individual stock by going to opening an account with Fidelity or Schwab, and you can go buy 10 shares of Apple or whatever you are interested in. But suppose you wanted to buy a share of Google and Apple and Facebook, all three of them. Well, you need to have a few $1,000s to buy shares, and maybe you don't only have $500. So this is what is a mutual fund. A mutual fund takes money from a whole bunch of people, pools them up, and some fund manager then decides and buys shares in different companies. So this way, by pooling money from, let's say, 10,000 people, everyone contributing $100, $500, $10,000, you have a few $1,000,000. The fund managers can then make a decision which companies are promising based on the research they do. They have a whole staff of people doing research. Different funds have different objectives. Some funds focus on growth stock, some focus on income generating company shares, some focus on bonds. So there are different asset classes. They have all a prospectus which tells you what the intention is. But this is a convenient way to invest in stock market because you don't have time to figure out what to buy, when to sell. But there's a fund manager's full-time job. He or she wakes up worrying about this. So this is a convenient way for most people to start investing in stock market. You can set up an account. You start saying, take $100, $200, $300 from my checking account every month and invest someplace. Over time, that can grow to be a sizable chunk, but you have to have the discipline to start it. So one of the most famous mutual fund was Fidelity Magellan. Fidelity is a company in Boston. Magellan was one of the very popular fund. Fund manager's name was Peter Lynch. So he even wrote a book. So if you want to even read that book, that is a good book to read because yeah, I was mentioning that one of the most popular person was a guy named Peter Lynch, who ran the Fidelity Magellan Fund, which did extremely well in the 80s and 90s. So he's now retired, but his book is a good one to read. Now, what is ETF? So ETF is an exchange traded fund. So imagine that what if we can replace that stock, the fund manager who we have to pay a lot of money, and replace him with an algorithm? That'll be much cheaper. Well, that's exactly what ETF do. ETF basically are exchange traded fund. They take some kind of a collection of stocks and they are predefined and you can buy a bunch with a little bit of money, everybody contributing, they have a pool of money, they buy those shares. So there could be exchange traded fund for all software companies or Dow Jones Industrial Average could be. So this is a convenient way to buy stock and lots of shares, lots of companies' shares without having to do all the analysis and pick something. So we look at some numbers that these are convenient way to invest in the stock market. Similarly, for the bonds, you don't know, should we buy the bonds being issued by state of California or state of Maryland or city of Palo Alto? And there are funds which take money from a whole bunch of people, pool the money, they buy a bunch of other bonds, and we can invest in them just like buying a little fractional share. So my point is there are easier way to invest in these things if you are able to use these different financial instruments. Similarly, for real estate, there are real estate investment trust, REITs, and we'll take some examples. I have a link here when give you more article how to invest $10,000. So it talks about what you can do. But point is there are different asset classes, and I'll be happy to explain more in detail as they come. So yeah. So somebody asked the question, Asim, are the parameters to the algorithm ETF tweaked real time? Answer is no. The ETFs usually the formula is predefined. And so they're more advanced robo traders when they do AI-based algorithm. I'm not talking about that. ETF, will take some example. Our standard shares, like all the biotech companies could be one ETF, or all the precious metal and mining. GDX is one of those ETF, which has all the precious metal mining companies. I wanted to invest in gold. I didn't know what to buy. So I bought GDX, which represents a whole bunch, maybe a few dozen gold mining companies. So this is a convenient and a safer way because you're diversifying between many of them. So difference between ETF and a mutual fund is all spelled out here. Main difference is ETF, in a mutual fund, there's a fund manager, and they're actively managing it, deciding when to buy, when to sell. ETFs are passive. You have some popular index. I'll talk what an index is. And you basically, by buying a single symbol, you buy a whole bunch of companies, diversifying your risk. And ETFs are traded like stocks. So in a one day, it could be bought and sold multiple times. Mutual funds are executed once a day at the end of the day. So market is falling fast. ETF is a good way to just get out of it during the day. Mutual fund, you have to do at the end of the day. And in ETF, there is no minimum requirement. So there's some small details here. So let's take a look at one of the most popular ETF of all times, SPY, SPY. What is SPY?
Quick
So buying,
question.
sorry?
Quick question.
Yeah.
Are there any recommendations between ETF versus mutual funds when investing?
So short answer is do your research, and you can easily go to finance.google.com or finance.yahoo.com. You can show the best performing ETFs, and we can do that together here. But I personally like to invest in ETFs because historically they have done as good or better than managed funds, which is a little bit counterintuitive because some guy who wakes up in the morning, worries all day what to buy, what to sell, should do better. But since humans have emotions and we talk ourselves into different positions emotionally, we end up making mistakes. So very few funds, managed fund, beat the ETFs. So other thing is expenses. In ETF, typically the expense ratio will be anywhere from 0.5% to 2.5%. And so suppose you put $10,000. So what is 2% is $200. Every year, $200 will be subtracted from your account, given as the fee for to run the mutual fund. Since in ETF, then there is no fund manager and his whole beautiful staff of people, the expenses are much lower. Could be 0.1% to 0.4%. So over 10-year period, you're going to pay much less in expenses in ETF. And performance is the same or usually better. So I prefer ETFs, but some exceptional funds like Magellan by Fidelity has consistently done very well. But so do your research was a short answer. And you can easily do the research. You can figure out whether. So look at SPY. So SPY is exchange traded fund. And basically, when you're buying SPY, you're buying a fractional ownership of 500 most valuable companies on the stock market. 500 of them. Which 500? There's a list available. You can check it out. And sometimes it changes. Some companies get added to S&P 500 index, some are subtracted. Who does the adding and subtraction? Well, the Standard and Poor, the company called S&P Standard and Poor does that. And so 500 largest companies by market valuation. There's a ratio. I'll show you what's included in that. So when you buy SPY, one share of SPY, which is trading at $326, when I took this photo about 10 days ago, October 30th, I guess, uh, they were, so you're buying a fraction of Amazon. You're trying to buy Amazon, is $3,100 a share, very expensive. Is buying a fraction of Google, you're buying fraction of Apple, you're buying fraction of Facebook, all those are part of S&P 500. So buying a single SPY is a great way to buy 500 companies. What are the chances that all 500 will go out of business? So that's why it's a good way to diversify your risk and hedge it. You notice SPY is heavily traded. A lot of people buy it. It went up, went down. What is it today? Just for fun. Uh, on my phone, we can check, and S&P 500 was 336.68. That's the fund. So I need to look for SPY. I'm looking at the index. I have to check it. It will take longer. It'll be easy to check on Google in a minute. Okay, so where are we? So yeah, Salman also makes a point that tax-wise, ETFs are also tax efficient, because what happens, mutual fund, they do a lot of buying and selling of different stock during the year. So whatever they gain, at the end of the year, they send you a statement that we had a capital gain of $687. So you have to pay tax on that. But ETF is like a stock. If you don't sell it, it's not a taxable event. So you only pay tax when you sell the ETF. Could be 6 months later, 6 years later. So tax-wise, ETFs are also more efficient. So we talked about these different asset classes. There's a stock mutual fund, there are bond mutual fund, there are exchange traded funds. So we don't need to dwell on that. So what's a portfolio looks like? So if you're just getting started, you may decide to have something like this. You can put S&P 500, you can put 60% there buying SPY, and you can buy some bond fund. Or you can, in your age, if you're young, maybe I was 100% stock, no bonds. I only started buying bond after age 50. But if you have a little bit more money, you can have a little more diversified portfolio, because inside the stock, there are subclasses. For example, small cap, large cap, international, emerging markets. And I'll show you some data. All of these asset classes performs differently. I'll find those terminology for you in a second here. All right. So this shows you, according to some research, that what cumulative, aggregate growth rate for the past 5 years is in yellow, and the purple is in the expected in the next 5 years. So S&P 500 did very well in the last 5 years, 10%, because of COVID and everything else. Expectation is 1.4%, but real estate is expected to do better. And some other asset classes, like emerging markets, may even do better. That's the expectation. You never know what's going to happen, but this gives you some idea what different asset classes performed in the past. So this is another chart which shows you what is hot in 1 year may not be hot the next year. That's why you have to do a little bit of thinking if you want to optimize it. But for example, in 2006 and 7, equities, stock market was hot. But then in 2008, we had a little bit of a crash. Stock market was minus 52%. So gold was hot. The next year we recovered, stocks went up 83%. Then next couple of years, gold was doing better. So you can, what my point is, that's why you need to do a little bit of research. You can work with a financial advisor. I work with them and realize their advice is really not that good. I should have to learn myself and become a bit of a knowledgeable myself. So that's what I did. And it's not very hard. It's kind of fun, especially
And
if you're
there
an
are some
engineer.
people, I think, on your waiting room.
No, I'm clicking away right away as I go. So there's 0 people in the waiting room, 98 people in the meeting.
Okay. Because I just got a message that
Yeah,
somebody.
people get anxious when it takes more than
Yeah.
30 seconds. Yeah.
Okay.
So let's talk about risk versus reward. So obviously, more risky asset classes, better is the possible reward. So if you look historically, money market funds are generate, 0.5%, maybe 1% in a return, but they're much safer. They don't fluctuate very much. A high quality bond fund will be the next thing. They may generate 2, 3, 4%. When you buy US government treasuries, that's a high quality AAA rated bond fund that will generate 2, 3, 4%. But some company which is maybe not as high quality wants to raise money, or some city municipality which is not as well managed wants to raise money, they may have to offer 7, 8, 9, 10% interest rate to attract money they need. So their yield is higher, reward is higher, but also risk is higher. This is called the low quality bond. So there are companies like Moody's and S&P 500 which analyze this company and give them a rating. The best rating is AAA, then AA, small a, then small A's, then B's and C's. So depending on how good your rating is, if IBM wants to raise money, they'll be AAA rated. They don't have to give a lot of interest to raise money. But if some company, I don't know which company I can think of, which is somewhat iffy, may have to pay much higher interest rate. Then you can see domestic diversified stock funds will be higher reward, higher risk, international even riskier. Then you go to sector fund. So you can buy a fund, ETF, which is just on real estate, just on biotechnology, just for silver and gold. So then they become very specific, then they're higher risk, but still more diversified because you're not buying one company, you're buying a bucket of companies, bucket of biotechnologies. So this is how you may want to invest is using an ETF, and you can decide how risk versus what reward do you want to entertain. So let me see, any question? Or feel free to unmute and ask a question too. Uh, so
I have a question, if but it might be completely off topic from this right now, but it's in regards to I think it's a ETF. It's called S triple Q. Are you familiar with it? It's
S
a
S
three times
triple Q,
leverage.
does it short
Yeah,
QQQ? Yeah.
right, exactly. It's a three times leverage of the
Yeah.
inverse of T triple Q. And so my question to that is if you buy X amount of shares, you're in it, and it starts going down. And since it's supposed to be the inverse of the market,
Yeah.
um, so theoretically you can make infinite money in a regular forward market,
Yeah.
but with the inverse, can you lose infinite market? I mean, infinite money, or do you lose what you invested only?
You lose what you invested only is the short answer. But this is a little higher caliber question, then everybody else will be bored out of their mind. So, but short answer is only what you put in. So
Okay,
it's not
cool.
infinite. It's not like writing a naked call, which we can lose a lot more than what you bargained for, which we may cover at towards the end.
So, I
Okay.
mean, I just want to. I know that like you said, this is a little higher caliber question, but I am still very curious. So if I never sell, does that ETF or whoever is managing that ETF, do they force me to sell ever at any point?
No, it's
Okay.
not a call. It's not an option. It's you buying a like SDS or S triple Q. So short answer is no. But hang on to don't go deeper in question because I'm talking to a class of 1 out of 100 people.
Okay.
You talk to me privately, but I've given you the correct answer already. The short answers. Okay, let's see if we can make some more progress here. Uh, so when I said small cap earlier, what do I mean by that? So market capitalization is a term which says if you can buy every share of a company, how much money will you need? That's called market cap.
Oh, you should.
Stock price multiplied by number of shares. So market cap is a way to look at what is the company worth. So right now, one of the most valuable companies, Apple, and that's worth is about $2 trillion. So, and then, sorry, small cap is a company which is market valuation between 300 million to 2 billion. Large cap is 10 billion to 200 billion. So all your General Motors, your companies like that will be in this range. And of course, companies like Tesla may be mega caps. So this gives you an idea that, and each asset class moves differently, behaves differently. So some people divide up some large cap, some small cap, because sometimes small caps have more ability to move up and down. So, and all this, let me actually bring in real time. I'm gonna bring up and show you some of these things in the real time. And let me share my screen so that let's go to, hello. Now let's stay here. Where were we? Finance.yahoo.com. So we can look at any company. Let's just look at for fun Apple because I know Apple. So symbol is AAPL. So let's look at Apple. No, I didn't type something, made a mistake. What am I making a mistake here?
Not from the beginning. Oh, yeah.
Hello, I keep clicking on the wrong thing. So let's click on Apple. So here, lots of information is available in real time. So it tells you Apple stock closed at $123. It was up $1.46. Previous close was this. Market cap is 2.09 trillion. So if you look at some other company, let's just look at Cisco. And here you can see the market cap is 187 billion. And it closed at $44 a share. So all this information is available for free right here. And it tells you all the things like earnings per share and other detail, which I can explain. Volume 17 million shares were sold yesterday. Tells you 52-week hand. So all this information is publicly available, very easy to see. And you can look at their financials. You can look at charts. So if you go to chart here, for example, you can see how the stock did in the last, okay, let's come to it's loading the stock chart. So you can look at last 3 months. Stock it's closed at $44, but it was $42 here. It was down to $36. You can say, show me year to date. You can look at even 5-year. So how Cisco has done, and then Max, like, all-time high since company. So all this information is available right here. So the peak it hit, $74 and was down, hasn't quite recovered. But if you look at some other shares, let's say Google, its chart will be, you can look at the chart here. This is just the 1 day, but let's look at Max. Is constantly has gone up from opening at $50, has gone up to $1,700. So all this data is available for you to look at for free. So let's go back to our presentation. Okay. So you may have heard of Dow Jones Industrial Average. Everybody reports that in the news every day. What exactly is Dow Jones Industrial Average? So it turns out it is selection of 30 companies.
Dow Jones Industrial Market.
Only 30 companies.
S&P 500 and Nasdaq 100. What are these?
Okay.
He's explaining those.
Here. So this is 30 companies, and the editor of Dow Jones, Wall Street Journal, company which owns the Wall Street Journal, selects which 30 companies. and they keep adding and subtracting. So it's not a true representation of all the companies because there's 7 or 8,000 companies which trade on the stock market. S&P 500, Standard and Poor 500, this was started about 1957. This is the weighted average of the 500 largest companies. So this is a better representation of overall stock market. You also have NASDAQ 100, which is the 100 of the largest non-financial companies. So NASDAQ 100 is a better representation of technology stocks, all of the technology stocks in the bucket. So you can buy QQQ and you'll be buying a fraction of ownership in 100 largest technology companies. So a lot of people, this is how they buy, because by buying a single share of these indexes, you're buying 500 or 100 companies or one. So this is a good way to start investing because you don't know which one to pick. So you pick an index or a bucket. So for example, Dow Jones Industrial Average is the weighted average of 30 companies. So I'm showing you like 3M was added in 1976, is still there. 3.8% of Dow Jones Industrial Average comes from this company, from 3M. So American Express is there, Boeing is there, Caterpillar, Dow, Goldman Sachs. You notice different percentages depending on the company and when were they added. The most recent addition is Honeywell, added in 2020. But some companies have been here since 1987. So it changes. They add and move companies out of this bucket. That's Dow Jones Industrial Average. If you look at S&P 500 or SPY, the ETF, which says that, this includes the following companies. And 500 companies, I'm just showing you the first 14. You notice that weighting average, Apple weight is 6.5, and something like Procter and Gamble weight is 1.2. So you get more fractional shares of Apple than P&G, and Visa is 1.1. So this says, again, you're getting a bucket, a basket of a whole bunch of those shares altogether. So if you notice how have these indexes performed in the last, let's say 1 year, this gives you a quick view. Since January, they all started up, if you started at the same place, how have they done relative to each other? You notice that QQQ, which is NASDAQ 100, has done up 38%. All of them are up, but the S&P 500 is up 11%, 10.97, and Dow Jones Industrial Average is 3.3. So you could have bought just SPY and you'll be up 10, 11% by now, despite all the dip which happened after COVID. But NASDAQ has done extremely well. So if you can get more than 5 to 10% anytime, you're doing very, very well. So 38% is phenomenal. So I'm just checking anybody has question, please feel free to chime in and ask too. Let's go to next slide. So let's see, I showed you a little bit how to read the stock. This is a stock chart of Apple, and it shows you the ending price. It has been up 259% since, I think it's maybe since 2016, since here, and what was closed recently. And this is the ending, that this is end of the day price. So during the day it could be up and down, but ended the day here. That's how you read the chart. And then you look inside, it asks you, because buying a stock on a stock market is really an auction. Somebody says, hey, I got Apple, 100 shares of Apple. Anybody wants to buy them from me, I'm willing to sell them for 120 bucks, 120. Anybody, any takers? And nobody says then, okay, what about 119? 119, going down. Then they lower to 118 till somebody says, okay, I'll buy 20 shares. That becomes the next price of Apple share being traded. This used to happen physically like this in a pit, people shouting back and forth till they agree on a price. But now it has become all electronic, so there's no shouting going on, but the same concept that electronically this is done, but this is the same concept, bid and ask. Somebody bids, somebody asks, and between they settle on something. So one of the important things to learn is PE ratio, price to earning ratio. That's, to me, is a good way to tell is the stock overvalued or undervalued. all other things being equal. If you look at historically, the over the last, whatever, 30, 40, 100 years, the price for this stock goes up, they come down, they go up, all kinds of things happen. You look at the average, the price to earning ratio is 17. By price to earning, I mean what is the profit divided by number of shares that gives you earnings per share. So price to earning ratio gives you an indicator. Price of the stock is $119. Earning per share is $3.28. You divide the two, you get this number of $36. Not dollar, 36.36. So my point is, when you see some stock which is over 17, you wonder, is the market going to pull it back? Historically, over the long period of time, it does. When stock is below 17, all other things being equal, chances are it's going to move up towards that. So this is, you can see here, even this stock is being considered overvalued. So during the stock market, actually, in 1982, the Dow Jones Industrial Average hit the recent low. It was down at that time was 777 that day. Actually, the exact date was August 12th, 1982. And now we know it went, when stock was high in 2001, this number became 43. The market was very overvalued at 43. That's when the 2001 crash happened. So it's more complicated than that, a bunch of other factors, but this is not a bad way to look at this. What is the PE ratio? If it's much high, there could be reason for concern. But of course, there are other factors involved. It's not as simplistic, but I want to at least be aware of what is PE ratio and what you look for. So somebody asked me, what is aftermarket in the previous slide? Well, aftermarket, see, market opens at 9:30 a.m. and closes at 4 o'clock in New York. So sometimes there's no more trading going on in the active market, but there's an aftermarket when people can try to buy and sell shares after market closes. So that's a good indicator how the market will perform. So this shares were after market was going down. It was closed at 108.86, but after hours, people were willing to buy them or sell them at this price. So let's look at a couple of other companies. IBM on the right-hand side, Anheuser-Busch on the left-hand side. So you notice Anheuser-Busch, the PE ratio is not meaningful because they're going to lose some money, but earnings per shares are negative. They're going to lose 37 cents a share. So that's why PE ratio is not meaningful. But look down here. It's not as overvalued as Apple was, or on the right-hand side where IBM is. Although IBM PE ratio is only 13. So this, just looking at that, looks like IBM should be poised to do better. Stock should go up. It's at 116 right now. So these are some of the things you'll begin to learn and look at quickly when you look at a stock. One of the things which you may want to consider is something called dividend. So many of the stock market, see, when a company, suppose company makes $1 billion of profit. What are you going to do with $1 billion of profit? Well, they can buy a company, they can start a new plant or a product, but the money belongs to the shareholders, people like you and me. So sometimes many companies will give portion of the profit they earn to the shareholders called dividend. So in IBM's case, they have been paying dividend for a long time. So they're going to expect it to pay $6.52 in dividend. So if you own 100 shares of Apple, you can expect a check of $652. So that gives an effective yield of 5.58%. So think about that. Imagine owning IBM, even if the stock doesn't go up. Suppose it stays flat for 5 years. You're still getting 5.58%, 5.58% every year as income. So stock goes up, that's the extra benefit. So many people just invest in dividend generating stocks because if you're a retired person, suppose you have $1 million in stock market, if you have $1 million in, let's say, shares like IBM, you're getting a 5%. That's like $55,000 a year check coming in. That's pretty sweet. So this is another strategy to buy dividend generating stocks.
Can I ask a question prior to the dividend topic?
Sure.
So first question is, what interface are we looking at here? Is this some tool that you use?
No,
Or is this Yahoo?
this Yahoo or Google. So finance@google.com. I do use a tool, but I'm not showing the tool. I'm showing you what you can look at right now. And a
Oh,
few minutes
fantastic.
ago,
Okay.
So right here, this is Google right here. All the data is here.
Okay, cool. Because I actually like that whole little green red slider for the value, and so it leads to my question, which is like McDonald's versus Chipotle.
Yeah.
How do we their prices per stock is so vastly different. How do you fairly evaluate which one is smoking and which one's more fairly evaluated?
That's why the EPS and PE ratio are important because they divide the stock price by earning per share. So this is a good way to compare because it takes all that into account.
So I would look at the EPS, not the bottom right hand corner where it says fair value.
Yeah, exactly.
Bottom.
Yeah, see, so of course, there's more than one thing to look at because there could be other issues like management, the competition, the execution, but that's what a fund manager looks at. But usually, earnings per share is a good way to neutralize different size companies and able to look at them side by side. Okay, so let's continue here. So what's the tax implication of dividends and reinvesting dividends? Yeah, if you get dividends, whether reinvested or not, you pay tax on that. That's Schedule B in your tax return is all about that. So suppose you generate $50,000 in dividend income, it's like income. So you pay the tax on that money. That's normal. So stock charts. So when you look at a stock chart, as mentioned already, you can look at up here 1 day, 5 day, 1 month, 3 months. You can set different intervals. You can look at lines. You can draw on things. What on the bottom is the volume. How many shares were traded per day that day? When you see a red bar, this means the stock went down that day. So when you see a green bar, stock went up that day. So the color coded on the bottom shows you how the stock did that day. But you can see the volume is going up. That is and stock price is going up. That's a very positive sign. The volume is going up and price stock is going down. A lot of people are dumping the stock. That's a negative sign. So this is what people who really get hooked on the stock market look for, those sign and symbols. There are all kinds of tools available, which tells you what to look for. And even a lot of these tools are free on Google and if you set up an account with, let's say, Fidelity or Schwab, they give you a bunch of tools to analyze and make those decisions. But again, for the people who are just getting started, you don't have to learn any of this. What you're going to do, you're going to buy 2 or 3 index funds and only check them once a month how they're doing, or even less than once a month. Like Andalib, who has a Robinhood account, that's what she would do. Now let's a little bit of switching the topic. How do people, by the way, if you're putting the things in the chat box, I will go back and carefully read every one of them. Right now, since I'm speaking to you, I'm not able to read all the comments. If something is burning, feel free to unmute and ask yourself. So how do you buy shares? There are different methods. Fundamental analysis, when you look at a bunch of factors, like what are the price earning ratio, with the volume going up and down, all those things. Value investing is some people who look for some stock which is undervalued for some strange reason. Like today, because of COVID, what stocks are really not doing well? Airlines, hotels, cruise industry. Now you can decide this is a temporary thing. When vaccines are available in next couple of years, those stocks will come back. So that will be an example of value investing. Some of you are too young to remember, but there was a contamination in Tylenol, and Tylenol company stock really went down big time. So some people bought shares knowing this is a temporary thing. You know, I don't know, Johnson and Johnson and P&G who owns it. So that's a value investing. Growth investing is looking at different trends, what stocks will do well. So one of the company I invested in, which went public this week, is called Luminar. So the symbol is laser, LAZR. So they don't have any profit yet, but they went public and stock has quadrupled in the last 1 week. Why? Because it's self-driving car. It's LiDAR for self-driving car and its overall security. So people believe that that's going to be a big industry. So the stock is going up because of that, not because the price earning ratio is good. The third method is what I call technical analysis. The reason stock price goes ups and down, people buy and sell, is we all are human. We have emotions. So we believe something will go up or down based on our analysis, based on what we heard as a rumor, based on what we overheard a conversation. So technical analysis says forget all that, because market knows all those things built in. So stock goes up, stock comes down, stock goes here. Technical analysis says you're going to watch certain signs. When the stock is moving up, you're going to jump on the stock right here. It's already beginning to move up. And if it goes down more than a certain percent, you'll be automatically kicked off. And then based on some parameters, you may jump on the train again, and it will automatically be kicked off the train at some point. So these things based on moving averages gives you signal when to enter, when to leave. This is a disciplined approach to investing called technical analysis. I've taken many classes trying to learn about this. I have formulas I can share with you sometime. Point is, you're never going to get the lowest price. You're never going to get out at the very top. That's not even an objective because nobody can time the market. But main point is in technical analysis, you have to look at the mirror every morning and say to yourself, I'm not that smart. I don't know when to buy and sell. I'm going to let the data tell me when to enter, and I'm going to sell something called it's called a trailing stop loss. I'm going to set a trigger point. Well, it will automatically sell my shares if that trigger point is hit. Main point is to take all emotions out of the equation of buying and selling. That's called technical trading. Because people screw things up because they get emotional. They make decisions which are not logical. So technical is that.
About, if I may interrupt.
Please.
So are there any software that could help you with that?
Yes. There are all kinds of software help with that. I've been using Stock Chart 2000. There YouTube seminars, webinar, just do technical trading in YouTube. You'll be overwhelmed with information and the books and do that. And I have taken classes. I paid $10,000 to take a class to learn all this and have my own formulas and Fibonacci numbers. I won't bore you with that because this is an introductory session. All I'm introducing you, there's such a thing. And main thing about technical trading is you follow simple 5 or 6 rules. You enter a share if those criteria are met. You have a predefined trigger point when you be kicked off the train. And if you have the discipline, you should do quite well. So 1 year when I was really doing it well, I was up 32%. But I'm so busy running a company, I don't have time for that. So yeah, like whatever. So if you want to learn yourself, this is a safe website for you to go. US government wants you to be an investor. So investor.gov, because many people are trying to sell you this or give you that or some course. So a good place to start is investor.gov because it's unbiased. It's from the government. I don't know how good it is. I've watched a little bit of it, but it's a video. You can go check it out. So I showed you what is hot. This is another version of that slide. That chart goes you even detail. So inside various things, you can notice how did different asset classes did every year. So some people are talking about short sell, day trading. I will cover those topics a little bit towards the end. So hang on to those questions. I will address them. A stopping point is coming in about 5 or 7 slides. Then I'll do that. So you can see here, large cap stock. This is the companies from 200 billion plus. What was that? I showed you the 50 billion to 200 billion. Yeah. So they annually, looking at a large period of time, they have an up 8%. The best year up 32%, worst year minus 37%. So you can see how different asset classes have done. The most volatile would be something like, like international. So yeah, up 32%, minus 43%. But they're so up and down that average is 2.69%. So you can notice here in every year how different asset classes did. So what's the point of me showing this slide? One point is that the different asset classes behave differently. If you have more than $10,000 to invest, you may want to break it into 2 or 3. If you have more than $100,000 to invest, you break that into maybe 4 or 5. If $1 million to invest, maybe 6 or 7 different asset classes. Because each year they behave differently, and each year you can make some moving around. So if you work with, let's say, Charles Schwab, one of the counselors there can help you get started and can give you, yeah, stock chart 2000, Muhammad, that is the one I used. Yeah, that's the one. TC 2000 is $30 a month subscription, but you also need to learn what to do with it. That's just a tool. You need to learn to use the tool. So that's what I took the expensive class for. Okay. So yeah, inside the S&P 500, you can notice that different things perform because, so my point is, since we don't know what is going to do good every year, we buy the index. Overall index does quite well. So you can notice different sectors inside will do differently. So if we bought the S&P 500 energy index, yeah, best year was 34, worst year was minus 34, but overall is at minus 4%. Not as hot as healthcare, which is on a long period of time is up 9.95%. Consumer discretionary. So all the things listed here, they're individual subsector ETFs. You can buy one of the one listed there. Just if you're interested in only in healthcare, you can buy the S&P 500 healthcare index. So my point is you don't have to buy individual company stock. You can buy indices, different sector funds, ETFs, which could be specific. So Sharik Riazi says, what's my recommendation about day trading or long term? So my point is both of them are possible. Long term is that you invest money in 1 or 2 or 3 of these instruments and you look at them maybe once a year to see how are they doing and should you be in or out. Day trading requires a full-time attention. You have to spend time and energy every single day. And you need to have a pool of money to play with, which can, there are some rules about day trading. I don't day trade. I don't have time for day trading. So I do more long-term. Someday when I retire, I'll play with it. But you can always take 10% of your portfolio and do trading with it if you have the time, but put 80, 90% in something long-term investment for the company which you believe are the right one to invest in. Okay, so this is, I'm looking at Schwab list. These are different funds they have in there. You notice they tell you this is Schwab S&P 500 fund. It's a large blended fund, 500 companies. How did it do in the 3 months period, 1 year period, 3 year period? These are annual return, not over cumulative. So over 10-year period, it did 12.9%. Since inception, it did 7.93%. So this is extremely good fund. If you just put money in S&P 500 index fund, it would have done very well with Schwab. So then they have other funds. They have U.S. large companies beyond just S&P 500. They have low volatility equity. This list is long, and you can see the performance of different funds. And if you have a Schwab account, it gives you all the details. What is the expense ratio? If they are socially responsible or not socially responsible, some other ratios, and you can just simply click and buy some number of shares. All right, so This is like looking at Apple again because everybody knows Apple. I showed you in real time that you have all this information available, dividends. It shows you in the chart here when the stock pays dividend. You notice every so often dividend is paid with a D. So that's a good way. Quarterly dividend is 20 cents a share. That's per quarter. So annualized is 82 cents a share. So if we had a, you know, if you had 1,000 shares of Apple, you'll be getting $82 every year as dividend. And they tell you the date, X dividend date when the dividend is declared, when it's paid. So if you buy the shares before on or before 6th of November, and you hold it long enough, at least till November 12th, you will earn this amount. So some people just play that game. They just buy the share right before dividend date, sell them after that. Obviously, stock knows that, stock market knows everything, so stock prices go up and down accordingly. So this is not an easy way to make money, but some people do that. That's what I mean by dividend. That you notice this company has been increasing the dividend since 1931. They've been paying dividend, and they have increased dividend every year for 66 years. So they used to pay 52 cents a share. Now they're paying $1.28 a share. So some companies which imagine some company which don't have to make a lot of profit. Let's say PG&E, because PG&E is always going to be around because they can collect money from all of us who are using electricity. So why would somebody buy PG&E in stock? Is it going to double? It's not like Google or Facebook. So they attract people by giving generous dividends. All utility companies do that. Other Exxon, Chevron, they give dividends too. So this could be a strategy when you can make a pretty good income having dividend generating stock. You still have a chance the stock price will climb, but you're also getting dividend. So this is what I was telling you. Announce the dividend, board declares, and if you keep it from this date, X dividend date, and you hang on to it till this date, then you'll be paid out. You'll get some money. And this is an example of different companies who dividend on stock. You can notice here how much, 55 cents, and what percent. So this company, GECC, their dividend based on that is about 12% dividend. That's better than you're going to get in many other instruments. So this is a strategy people use to buy stock with generous dividends. So how do you start investing? You can literally walk into one of the Schwab and Fidelity. Vanguard is in Pennsylvania. They don't have physical office to my knowledge, but online. But here you can walk in and they're helpful. They'll fill out the forms. And not a big deal. Yeah, I have a link for you guys. Start investing with little money. Guide article tells you what to do, how to invest. You may want to check that out. And it's just no fees just to set up an online account. You can start an account with as little as $100, especially in retirement, if you have IRA or a 401k or rollover 401k. So my advice to you is try to get into a discipline when some amount of money is automatically taken by one of these companies from your checking account, so you never have to worry about it. If you have to write a check, you're going to forget it. You're going to justify not doing it. My formula to you young people is, if you put 20% of your gross in savings, you will be a millionaire before you hit 50. 20% of gross. Now, so if you make $100,000 a year, you want to put $20,000 away. Now you have many instruments. You have 401k. If your company offers 401k, start there. Especially if company matches 2, 3, 4%. Some large companies do. That's like free money. And then if not, then you can have a Roth IRA, or just direct investment like this. So do that. If you follow that rule, you will be a very happy person when you get to that middle age. So now the question is, when should I start investing? Is the market too high already? Is it too dangerous to go in? Answer is nobody knows. We all don't know. I sat out, when COVID hit, I got out of the market afraid everything is crashing. And I sat there afraid for like 7 months when market doubled. So don't make that mistake. The way to do that is something called dollar cost averaging. So dollar cost averaging is a technique in which you buy some number of shares every day, every month. So month one, you invest, let's say $30. And since the stock was $30, you got 1 share. Next month, stock went to half, you got 2 shares. Third month, stock went to even lower, you got 3 shares, but you're still putting $30 every month. So if you look at that, if you do the math, your average price will be $21.66. If you came in the wrong month, put all your money in month one, it will not be as attractive. Sure, you can get lucky and come in month 3. Yeah, that'll be nice, but nobody can time the market. Smartest people on Wall Street do that every day, trying to time it. You can't. So dollar cost averaging is a smart and safe and proven way to go into the market. So you have $10,000 to invest, you put $3,000 every month. Over next 3 months, you will be fully invested, but you evened out your investment over the three months. So how do you buy shares? Well, once you set up an account, it's not complicated. This is what the screen looks like. So this is my account. I logged in, and I say I want to buy Apple, and this was actually for a call option. So this is probably more complicated than that. But I was buying a call. I haven't talked about what call options are, but it looks like this. So I can explain. We can even try to buy some shares now, show you how you do. But you simply select a few things, and it takes no time. And in 2 minutes, you can purchase some shares. And it'll tell you exactly how much it is, and this is how it goes. So let me pause here because my last topic is about options. That's advanced topic. So I want to make sure that people are interested, but we have till 8 o'clock, so we have 21 minutes. So I'll cover that in last 15 or 10 or 15 minutes. But let me just take any questions people may have before I go too far. So, yeah, Reshma is talking about charitable remainder trust. That's a little advanced topic, but okay, point taken. Not going to cover it here. Let's see, anything else? And you can also, by the way, unmute yourself and ask me a question. I'm just scanning the chat box here.
Yeah, hi. I have a question regarding this IPO shares. Is there a chance that we go and buy those shares which are IPO, like DoorDash, before even they hit stock market?
So the short answer is no, unless you're already rich, famous, and companies which are going to be taking companies public want to sort of bribe you with giving you some pre-IPO shares. So the way it works is, the short answer is no. The way it works is when a company is going public, they're underwriters which is going to now try to market their shares to public and to institutions like big mutual funds. They go to their roadshow, they go to mutual funds, say, look at this company, so hot, it can do great. Would you be willing to buy a couple $1 million worth of shares like that? So when they're ready to go public, there's some number of shares are allocated for their retail customers or special customers. It's kind of a favor these bankers do. So a company is going public by Goldman Sachs. Let's say Schwab will get some allocation of, these are 20,000 shares you can buy at IPO. And Schwab will then talk to their most valuable customer they want to make happy, say, do you want to buy some shares? We can allocate you 20 shares or 200 shares. So short answer is, if you're not one of those, their very most valuable customer, no chance, especially for hot IPO. I was one of the company FireEye when went public. It was started by my college roommate, so he gave me an opportunity to buy at IPO 5,000 shares. So there went up $20 a share. And next day, the stock doubled to $40. So if I had sold everything next day, I would have doubled my money. Of course, I was not so smart. I sold some, but held on to a bunch more. So, you can get some friends and family allocation, but short answer is DoorDash, forget about it. All right, let's see. Anybody else has other questions?
I have a quick question regarding, as you know, interest rates are record low now, and government is also printing money to support economy. So how you see the inflation in the future, and its impact on stock market or any investment?
So short answer is, for 10 people you ask, there are 11 opinions. Because you would think with all the money printing, inflation will be high, but it hasn't been. So there are a bunch of other factors in play. So I will speculate. I shouldn't speculate, but if I were to speculate, I'll say I don't see inflation getting out of control. There's enough smart people monitoring, steering the bus, and there will be some kind of a strong recovery. So things should be under control, but I don't know. The short answer is I really don't know. I'm operating with that assumption. Let's put it this way.
Thank you.
And yes, there are ETFs for cryptos. I don't know what are they called, but quick Google will reveal that. Actually, let's do that now. We'll say ETF for crypto. So that looks like there are a whole bunch of them. So there you go. So it's really as simple as that. Let's see what other questions people had here.
Quick question.
Yeah.
Can one buy international stocks
Yes.
online?
Yes. Same way, if you have an account with one of the TD Ameritrade, E-Trade, Fidelity Schwab, you can. And there's something called ADR, which allows a foreign company to list its shares on a US, and you buy ADRs. But this is all behind the scene. As far as you're concerned, yes, you can. For good online stock trader, my point is, don't look, Sayed Amin was asking, don't look for the online stock trader. Look, my point is educate yourself. Go read finance.google.com and okay, simple thing is Money Magazine. Subscribe to Money Magazine, and if you're more adventurous, to Barron. Just read Barron for 3 months, once a week. It comes once a week, and the IQ will go up about 2.5, 3 points. And just open an account with Fidelity or Schwab, and just start buy with some ETFs. Don't get exotic. Can I invest from my IRA account? Answer is absolutely. So what other? Somebody, Bilal asked the question, for newbies, would you suggest playing with paper money, Thinkorswim? Yes, I do recommend paper money. When my kids were small, I gave them $10,000 of paper money. And they were so excited every Sunday on dinner table, say, hey, I bought McDonald's. I made $2,000. Yay. So that was a good way to introduce them to stock market. But yes, using paper money is a good way to see you have the discipline and you don't get into emotions. I think we covered. All right, so let me go to my last topic here. Now this topic is a little bit more exotic, not for the uninitiated, because the purpose so far was give you a big picture. So this is something, but I think some of you may find it intriguing. What's an option? The option comes in, there are two types of option, calls and puts. So let's start with call. Call option, you can buy a call option on any one of these shares, gives you a right to buy the shares at a certain price anytime between now and a certain date. So for example, I can say Apple was trading around 120. I can go and buy a right to buy a share of Apple, let's say for $125, anytime in the next 90 days. Why would I do that? And it'll cost me some money. It'll cost me, let's say, $2 to have that right. Because if the stock goes to 130, 135, 140, I just made 6 times the money I invested. So this is a way to speculate. If you believe a stock is going up, you can buy a right to buy at a given price with it. So let's define these terms. Strike price is at what price I want to buy the right to buy the shares by some date. So every Friday, options expire. So you can buy right to buy option this Friday, 2 Fridays from now, 3 Fridays, or even a year and a half, 2 years from now. Longer the time period, days remaining to expiry, higher the premium I will pay for that privilege. because a lot of things can happen over the next, longer the time frame, more uncertainty, higher the premium. So let's see how it works. Let's see how it works. So this is, for example, any option. 2 months or 3 months before, there'll be big time premium. As you get closer to the expiry date, premium eventually goes to the zero the day after it expires. So what do I mean by that? I'll show you some examples. But let me, before I go there, just like there's a right to buy a share, it's called call option. There's something called a put option. It's the opposite. Is if you buy a put, you have a right to sell a block of shares at a given price anytime between now and the expiry date. This is the opposite of call. So if I believe a stock is going down, let's say Apple is 120. I believe Apple is done. Apple is going down to $100, maybe even $80. I can buy a put, which will give me the right to sell my Apple shares at, let's say I pick $120 to somebody at a given period of time. Let's say I choose between now and end of February. If I buy a put, I'll be able to force you to buy the shares from me at $120, even if the shares were trading at $90. So if I believe stock is going down, I buy a put. It gives me the protection. In case stock goes down, I'll be able to get out at the price I chose. So let me pause here. I want you to absorb this. A call is a right to buy a share. A put is a right to sell a share at a certain price, which I pick. I pick the shares. So let's take an example. This is from actual account from Schwab, showing you Apple. This was done, I did that like a month ago, maybe. Closed at $119. And it's showing you how much would I pay for that right. On the left-hand side are the call option. Right-hand side are the put. Left is call, this is a put option. So let's look at this. Stock was about 119, let's say 120. So at 120, I did that like a week before. I did that in like a November 13th. So in 6 days from that, when I did this, Friday, 6 days later, November 20th, I can buy a right to buy the shares at 120 for $1.56. Why would I do that? Because I believe the stock is going to 130. If stock went to 130, this option will, as it closer to that date, will be worth $10 because I have a right to buy the shares at 120. If stock goes to 130, I just made $10 on an investment of $1.56. That's like 5 times my money, or more than 5 times. What is 10 divided by 156? So this is a huge leverage. So you can control a much bigger share of stocks by using options. Now, suppose you buy this call option, you pay because they're sold in the buckets of 100 shares. So if you did that, you will pay $101.56 times one contract, 100 shares. So you'll pay $156 for this privilege. What can happen? Stock can go below 120. This goes down. It stays at 120, doesn't move, or it can go higher. So let's say it goes to, let's say, $130. Okay. What will happen? I'll be able to buy the stock at 120 because I have a call option. I can sell it for 130. So I'll make $10. And my price was only 156. So I have a pretty good profit. If stock stays at 120 and goes below, my total loss is $156. So check this out. Most I can lose is $156. How much can I make is unlimited. If stock went to $150, I would be able to make $30 a share because 150, I have a right to buy at 120. So it's $30 difference. So for $1.56 investment, $156, I'm controlling 100 shares of stock. And if it goes to 150, I'm going to actually divide this. How much is $30 profit divided by $1.56? Yeah, I made 19 times my money. That's why people do options. Now realize that you can also lose the $156 if stock doesn't go high. So there's a risk. That's why it's a risky deal. Yeah, please go ahead and ask the question.
Question for you is when you say you have the option, do you have to be online at the moment that it happens on that Friday, or is it automated that if it was above your amount, it would just be an automated transaction?
No, it won't be. You have to be, it doesn't have to be on that Friday at that moment. Anytime between now and then, you have a right to exercise your right. If you forget to exercise your right, it poofs away, it goes away. So that's why when you're doing option, you have to have a calendar and remind yourself to get online and physically do something, buy, sell, trade, whatever. It's called closing your position. So somebody asked the question, what is a warrant? Warrant is something totally different. But just to explain in one sentence, just like at work, you get a stock option, you get an option to buy some shares, that's a different option. Warrants is an option for some company, an entity, not an individual, to get some shares if some conditions are met. So when you take venture debt from a bank, they want warrants because the company does well, they can buy your share at today's price. The price goes up, they can make some extra money for that. So warrants are something totally different. We're not discussing warrants today.
I have one question about. Can you hear me? Hello.
Sayyid Ali, ask the question.
Yeah. So it is offer for the every stock, or it is companies offer? I mean, this option is I go to for airline at the moment and block for the
The
1
short
year.
answer is not every stock, but majority of the stock. It's easy to find out. You can, we can quickly go to Google and say, option trading for what? Pick a number.
Airline, American airline, just like
American airline, or let's call it American. I think American airline for sure are options are traded. I know that. I don't need to even look it up. The short answer is yes. And here are the American, where does it say American Airlines? What did I get here? Is it, I think here they are. But short answer is yeah. Companies like American Airlines, definitely options are being traded. So answer is yes. But some obscure company, there may be no option. But anything like American Airlines, yeah, there are options being traded.
And you can book for a 1 year. I mean, either they. I mean,
yeah. I'll show you that in a second. So you notice here, this is for 6 days from that day when I did this. This is 2 weeks later, 13 days. You notice for, again, 120, here my price was $1.56. Now, since 2 weeks out, the right is more expensive. It's $2.29 because there's a more time premium, more things can happen. So the price for this transaction is higher. Let's even look at, I'm looking at now, January of 2022, 433 days out. I can still buy the right to buy Apple at 120 for $17.35. So I can control, I don't have to buy Apple shares. I can have a right to buy them. And actually, when time comes, suppose Apple goes to $500 a share between now and January 2022, I don't have to come up with the money to physically buy the shares. I can sell my call option to somebody else. They trade like stocks. So this price, suppose I had bought this, paid $17. If stock moves to from 120 to 220 anytime in the next 1 year, I can just, this will be basically $117. I can just sell the call option. It's called closing my position. So what is an option? This is a way to have leverage. If I had to buy 1,000 shares of Apple at $100, I have to come up with $120,000. Most of us don't have 120,000 lying around, unless you use margin, because Reshma wanted me to talk about margin. Margin is basically further leverage when you can borrow against your Apple shares. You don't have to have 120,000. You can have $60,000, and stock brokerage company will use that as a collateral, give you the other 60,000. Don't do it. It's high risk. That's how people go out of business. So don't do margin. That's what margin is. I'm not gonna encourage you to do margin. But anyway, come back to this thing. Do you understand how this options, call options, gives you a right to buy shares? How you can really leverage your money? Anybody wants to, and I could have clicked on any one of these plus signs. I can see 125 days out, 100, 200 days out. It just, this premium will keep going up as further out I am, because time premium, more things can happen. So let's see any questions. Oh, sorry, I'm jumping too far ahead. Any questions? What did you ask? Can I close an option partially? Answer is yes, Soban, you can close it. Suppose you buy, but the unit is a contract. Contract is 100 share block of 100 shares. Suppose you bought 3 contracts. Yes, you can close one contract on Wednesday, another contract in Friday, and so on and so forth. Yes, you can. The unit is 100 share, which is called one contract. Do I need any special account to trade option? Answer is yes. It's not special account, it's special permission, because you have to, they have to sort of interview you, make sure that you're not illiterate and likely to lose money and blame the company that lost money. They want to make sure that you have, what is your level of experience with that? It's kind of self-declaration. You don't have to pass an exam, but you have to kind of answer a few questions, say, yes, I have enough experience investing. I have like 10 accounts with Schwab. I'm only allowed to do option in 2 of them. So I think you have to be qualified or to be allowed. Can you sell or transfer options? Yes, it's just like a stock, basically. It trades like a stock. So you can close it, you can sell it anytime. Is short selling haram? According to me, no, but this could be a philosophical argument which is outside the scope of this conversation. Is speculation. So
Hi, I have a question. Yeah. Can you hear me?
Yes, I can. But only I hear you if you continue to speak. Since you're not, okay, what is short selling? Somebody asked what short selling. Short selling is selling a stock. Well, if it's going down, you can sell a share and hoping to buy it back when price goes down. So if I really convince myself that Apple is going down to $80, I can sell somebody. Actually, the way to do short selling is a put option. I can sell a put. So I can buy a put. Put gives me right to sell the shares at $120, even if stock is going to 90 or 80 or 70. I'll be able to sell my shares at 120. Right here, you can notice here, Apple. If you notice, if you want to be able to have a right to sell shares in the future at $120, this is the price. Put price is $2.95. You notice it goes down as you go lower in price, because the more chance of it's going down, then it's not costing. But you want to force somebody to buy at 123, you have to spend $4.79 to buy that right. So it goes the opposite direction of call. So let's.
I have a quick question.
Okay.
Can you explain geeks that we use in options trading?
Geek?
Yeah, I mean like delta, theta. Those are some different things that you have to keep in mind while trading options, right?
So short answer is no, I cannot answer because I'm not familiar with those terms. Don't know. So let me talk about the safest way. Well, I think I already covered this topic, that you notice how far out you are the option gets more expensive, call options, because time premium. So let me talk about, let's talk about the safest way to make money in the stock market. You guys, some of you won't even believe me. You cannot possibly lose money using this technique. The trick is you have to own the shares. So think about that. If you own a share in a company, you may be able to sell the right for anybody to buy a block at a given price, basically sell a call. It's like renting a house. Suppose you have a house and you have a couple of rooms, you can rent out Airbnb or something, and you're getting some rent. It's like that. You can sell a call, writing a covered call, because you own the shares. So sell somebody the right to buy the shares from you. Suppose you bought, my point here was you keep collecting this rent as long as you hold the property. Let me give you an example. Suppose you own 200 shares of Apple and you bought them, let's say at $100 or something. Now it's 120. So if you sell somebody the right to buy the shares at 120, you will collect $4.95 per share. Since you have 200 shares, you collect $990 premium by opening that position. If the stock stays below 120, you just made $909 rent. Suppose stock goes higher. What happens then? If stock goes above 120 between now and end of December, then somebody will buy the shares from you 120. So you made $24,000 by selling the 200 shares plus the 990 as rent. If it doesn't, so you make money because you bought, let's say, Apple at $100. So you made a profitable deal. Somebody bought it for 120, plus you collected rent. The funny part is you can keep renting every week or every 2 weeks or every 4 weeks. If stock doesn't go higher, you keep collecting rent. This is the safest way, if you own the shares, to make more money in the stock market by writing what's called covered calls. You're covered because you own the shares. So you can sell those calls to other people. They're paying you premium. If the stock goes high, they will exercise their right. They'll buy the shares from you, but hopefully that was at a price higher than you purchased, so you made money. What you lose is the additional profit you could have made because stock went to 130. You bought at 100. You could have made $30 per share, but you only made $20 per share because you had sold that right to somebody. But you also collected rent. For the stock which don't go up and down too high, you can keep collecting every week for 6 months. So I want you to appreciate writing covered calls being one of the safest way to make money. So that's the risk-free trade I mentioned in the start. That if you own the shares of some company, by selling the call options to other people, opening a position by call, you can keep collecting this rent. And you can do that week after week after week. So.
Question. If we were to do this inside of an IRA, this or any other type of investing in an IRA, is it fair to say that that is one way to not have to keep track of purchase price and sell price and all this stuff because it's all tax-free?
So short answer is no, for 2 reasons. A, mostly in IRA, you're not allowed to do options.
Understood.
You can find some unique custodian who may allow that, but in general, answer is no. In Schwab, answer is no. Number 2, yes, you're not paying tax on the gain in an IRA, but you still have to keep track of all these things because you need to know when to buy and sell the option. So that doesn't take away. That's why trading option requires some focus. You need to pay attention and don't forget. If you forget about it, then they can expire and you can end up not collecting the rent or lose money, but you have to be on top of it.
Got it. Thank you.
So writing covered calls, I think we just did this example. What I wanted to say was, if you sold Apple 120 calls every week, you could be collecting like rent $310 every week. So in 6 weeks, that's $1,800 you collected. So that's what I mean by the safest way to make money in stock market is writing covered call. So yeah. So if you got this so far, let me make it more interesting for you.
Just one question
Yeah.
regarding that. So when we're saying we are renting every week, does that mean we are hoping that the stock will not be sold, or how? What do you
Yeah.
expect?
Yeah. So you suppose you write for 1 week call. By Friday, if nobody buys those shares from you, you still own the shares on Saturday. Say, yay, I can rent the room again. Then if nobody buys, you say, I can rent the room again.
Cool.
So,
And if the stock got sold, like somebody bought it, then you won't get money till at least a week, right? So you can
yeah,
buy
then you
further after a week, more shares, and then rent it. Is that
exactly.
correct?
Yeah, just like if you own, somebody buys your house from you, you have no room to rent now, but you have
Mm-hmm.
lots of money by selling the house, so you can buy a new house and start renting again.
Okay. And usually, which app do you recommend, like, to use this for this options or covered options?
The same,
Robinhood
wherever you choose to have it, your account where you buy and sell shares, E-Trade, TD American Trade, Fidelity, Schwab, all of them offer this. You don't have to have
Even
a,
Robinhood?
sorry?
Robinhood also have this.
I don't know. It probably does. Robinhood is quite advanced. I'm sure it does. I don't have a
Okay.
Robinhood account, but I'll be surprised if they don't.
Oh, great. Thanks.
You mentioned that options is not always available to people who are starting. So what about the writing covered calls?
The same thing. To write covered calls is, yeah, you can easily qualify for that because that's not a risky strategy. But I do know when I wanted to write calls, I had to like get approval from Schwab that I'm allowed to do that. It was not a difficult interview, but I had to answer a few questions and say, yeah, I got it. I know this stuff.
Okay, thank you.
So let's make it a little bit more interesting. I only have 3 slides left, so I won't hold you too long. Suppose your neighbor's house is empty. He's gone to Florida for the winter. You got the keys. What if you start renting a room in his house? Can you do that? Well, yeah. So this is called selling naked calls, not covered calls. You don't own the share, but you can still sell it to somebody and collect the rent. Now that's much more risky because the stock does go to $150, Apple in this case. That person is going to expect you to sell the shares to them at 120, but you don't own the shares. So what are your options? You'll have to buy it on market for 150 to satisfy the obligation. So naked call is much risky strategy. So theoretically, you can lose infinite amount of money because what if stock went to $5,000 a share? And not likely, but can happen. So naked call, I'm not telling any of you to do this, but I'm saying it is possible. Covered call, you own the property, so you don't mind somebody exercise the right. Okay, please go ahead, take my shares. I'm already making some profit. Naked call, you don't really own the shares. But since you don't even own the shares, you have, you don't have to spend the initial $10,000 to buy the shares. So this is this is very much speculation. This is like Jua. So you are now speculating. But if you do the math, this is the math here. You can sell a call option even if you don't own the shares. This is risky is if somebody else exercises their right, you'll have to buy it with the stock went to $200, then you'll have to buy at 200 and sell it 120. So you lost $80 times 200, $16,000. But if it didn't go over 120, you just collected the rent and you can do that over and over again. Just to conclude, a small twist. What if you asked your neighbor, you're going to Florida anyway, why don't I rent the apartment from you, pay him some rent, and then rent out the room? Is that dangerous? Much less dangerous because you technically have the place. You can do that with options. How? you buy a call, long-term call, 4 months out, 6 months out at 120. So if necessary, you can exercise that right and buy that 120, and you start selling calls and start collecting your rent. In case stock goes crazy, you can exercise your call option, buy the shares, and give it to the new guy. So this is called a spread. Technical terms are strangles and straddles. So it can get quite exotic. I don't want any of you to start doing this. I'm just introducing you to the things which are interesting, could be done. You could be writing these naked calls and covered calls and spreads and able to get the delta between them. You can buy a long-term call and thus start selling and collecting rent. I just wanted to blow your mind that there's quite interesting things that are possible. If you really had too bored and wanted to play with some money. And this could be, if it goes your way, it could be very, very profitable. So then I have an example how all this works. I'll upload the slides. I don't want to hold people any longer than we are about 15 minutes, 13 minutes over or 10 minutes over. But there's an all example how you do that. You can buy a long-term call. In this case, I bought a call for April 16th and I paid, let's say 500 shares. You can write a covered call every 2 weeks. You can collect this rent. And then you can buy a long-term calls in case it goes crazy, you exercise this option. So it reduces your upside, but gives you a protection in case you don't have unlimited exposure. That's the bottom line. So my summary is that hopefully, I just wanted to see investment is not complicated. There's a simple ways to start investing. Get your IQ up, read Wall Street Journal or Barron's or Money Magazine. It's not complicated, but it can become much more interesting with options and those advanced techniques if you wanted to go that direction. But all of you should be thinking about putting up to 20% of your gross income away in some instrument with the help of ETFs and mutual funds. You'll be well served by the time you hit 50 to 60 years old. You'll be set for life. So follow that advice. Okay, that brings us to official conclusion of the lecture. Let me see if any questions I can answer for anybody. Thank you, Ms. Ron. Very good to have you here. And yes, we shall do the dinner if once we are allowed to do the dinner. Absolutely. So, anybody wants to, because there are many in chat. Somebody can either ask a question or tell me that answer my question, and I will.
Naeem, can I ask you a quick market research question? This is your old golfing buddy, Salman Sohrawardy. We won the tournament together.
Thank you. Good to hear from you.
I'm a big advocate for telling everyone to invest in index funds and ETFs, low cost. I'm very against managed funds. Occasionally, you'll run into someone who will tell you that certain long-standing managed funds have outperformed index funds over the long term. That I believe the reason for that is because over the long term, many managed funds, if they are under a big umbrella of funds, say American funds or something else, when other mutual funds fold, they are able to basically bring their portfolios into, funds that still are continuing on. So basically, every time the market drops huge, and a bunch of actively managed funds go out of business and basically liquidate, those funds that are managed by large companies, American funds, and so on, those assets go into other managed funds, and those funds continue basically having got all of those equities at rock bottom prices.
So the point you're making is?
The point I'm making is sometimes you'll see actively managed funds that have outperformed index funds over long periods of time, decades. Yeah, and I'm contending that that's really false because they're including basically the carcasses of other actively managed funds. Okay. What I can never find with all my Googling is articles and research that prove this point.
I think
I'm wondering if you've ever come across anything like that.
The guy who started the Vanguard, which is one of the most respected family in Pennsylvania, he recently died. I forget his name right now.
Jack Bogle.
Yeah, he extensively wrote on this topic.
Hmm.
And if you Google his name, there he proves the point what you're making.
Okay, great. That's exactly what I'll look for.
Yeah, you look for some a lot of 2 or 3 articles wrote, but exactly the point you're making. You make a good point.
Okay.
Salman's main point is index fund, good choice.
Yeah, and I always advocate for that. Okay, and thank you so much. This was very informative. Thank you.
Thank you, guys. Anybody else? Any question before we say goodbye to you guys? If not, Andalib, do you want to come and close it properly?
Quick comment. Was
Yeah.
it back in 2008 when during the downturn in the stock market, the U.S. government said that they outlawed naked cover calls for a few weeks. The market was going down.
I did not hear that, but that'll be really going against free market thinking altogether that they're going to ban covered calls. I can,
No, for
people,
2 weeks, for 2 or 3 weeks they did while it was going down. I just wanted to confirm that I heard something like that on CNBC, so I just was
yeah, I
wondering.
don't know about anything about this, but I know people have in the past, from time to time, halted the stock market trading for a few days for reasons like that. So people were panicked, people are all freaked out. So one way to let them people get chill, so they have halted trading. So it could be something like that. So it's not impossible what you heard. It makes somewhat sense. Andalib, do you want to say any parting
Naeem,
words?
sure. First of all, Naeem, thank you so much for your time. And I think we should do a part 2. It's like it's a lot of interest, and I think the people still have questions. So it would be great if we can do part 2.
Yeah.
And I can coordinate with you on that.
Okay.
And just apologies for the capacity, but we will be posting the replay through our social media channels, Facebook, LinkedIn, Twitter. So follow our channels and our website. I posted already. It's opensv.org. Thank you so much for joining. And if you have any questions, if you have any suggestions, ideas for the webinar, what do you want to hear? What do you want to learn about? Please feel free to reach out. Thank you so much.
Thank you, guys. Have a great evening. Talk to you soon. Bye-bye.
Bye.